look at a trader we'll call Trader A. He hits his target 70% of the time. He feels like a market wizard, booking wins almost every single day. Now, compare him to Trader B, who only wins 30% of her trades. She endures frequent small losses and pushes through brutal dry spells that can last for weeks. This chart shows their end-of-year results. Despite constantly taking hits, Trader B has doubled her entire account. Meanwhile, our wizard, Trader A, is struggling just to break even. Most retail traders get caught in the perfectionist trap. They obsess over being right on every single setup, trying to boost their individual win rate instead of looking at their overall systemic profitability. Chasing a massive win percentage usually requires taking tiny profits to guarantee a hit. That creates a fragile system where one bad day wipes out weeks of hard work. By contrast, building your strategy on mathematical probability ensures you survive the inevitable losing streaks. The core engine behind every single trade is the risk-to-reward ratio. It compares exactly how much capital you are willing to lose against how much you aim to gain. This diagram illustrates the expectancy formula. It calculates your strategy's average expected profit per trade over a large sample size. You multiply your win rate by your average win and subtract your loss rate multiplied by your average loss. Let's run Trader A's numbers through it. He risks $100 to make $50, giving him a 1 to 0.5 ratio. With a 70% win rate, his math resolves to an average net profit of exactly $5 per trade. Now look at Trader B. She risks that same $100 but aims for $400, a 1 to 4 ratio. Even though she loses 70% of the time, her average net profit per trade jumps to $50. She is 10 times more profitable, despite losing twice as often. A few statistically planned large wins easily erase the financial damage of dozens of small mistakes. You cannot simply demand a 1 to 3 or 1 to 4 ratio and force the market to provide it. This chart highlights the price delta. This is the actual physical distance between your entry point and logical technical zones, like supply and demand areas or previous swing highs. If you place a fixed 1 to 3 take-profit target squarely inside a major resistance zone, the price action will likely reverse before it ever reaches your line. You forced the math, and it ruined the trade. Instead of using random pip counts, you need to identify the invalidation point. Your stop loss belongs at the exact structural level on the chart where your trade thesis is definitively proven wrong. Some traders try to cheat the system by setting incredibly tight stops to artificially inflate their reward ratio. But doing this usually means standard market volatility knocks you out of the position before the real move even starts. A valid setup only exists when the chart's natural structure accommodates both a safe invalidation point and a clear path to your target. If the math and the market structure don't align, the professional choice is to walk away. Having the math on your side is logical, but executing it feels brutal. You are signing up to lose 7 out of every 10 trades. This visual represents the drawdown desert. It is an extended, grueling sequence of consecutive losses that tests your resolve. This is exactly where most intermediate traders abandon their perfectly viable systems. To survive this phase, you have to detach your ego from individual trade outcomes. You aren't failing because you hit a stop loss. You are simply acting as a mechanical data collector gathering sample points. A mathematical edge on paper means nothing if you lack the psychological discipline to execute it through a multi-week losing streak. You protect your psychology during those drawdown periods using active trade management. Look at this graph illustrating the 1R rule. Once a position reaches a 1-to-1 profit ratio, you move your stop loss to break even. This completely removes the risk of ruin, giving you a free shot at the final target. You can also utilize runners. Close 80% of your position at the primary target and leave the remaining 20% open with a trailing stop. This technique captures those massive, unexpected market moves that supercharge your account. Mastering these mechanics forces a shift in your identity. You stop acting like a gambler trying to predict the future and start trading like a professional who trusts the probabilities. Build your own mathematical edge today. Download the FXNX position sizing and RRR calculator to evaluate your strategy, and open an NX1 account to put the math in.